Welcome to another episode of A Quest for Twice. In this episode, I'm going to review the latest quarterly business performance from Atkore and Ingredion. Atkore had another outstanding quarter. So this table tabulates the quarterly performance in the second quarter versus the first quarter of 2021. And as we remember, Atkore has two segments, the electrical conduit and the mechanical. So Atkore had an outstanding Q1 performance reported in February of this year. They just released its second quarter performance in this week. In those two segments, Atkore's performance was even better than the outstanding Q1 performance. Revenue side, the electrical segment increased revenue by 50% from 1 year ago, compared to 19% in Q1. The mechanical segment increased revenue by 15% compared to 1% in Q1. So overall, Atkore's revenue increased by 40% because the electrical conduit is the larger segment. Atkore also had outstanding EBITDA. In second quarter, its electrical segment EBITDA more than doubled at 144%, compared to nearly double in Q1. And its mechanical segment actually had less EBITDA at a reduction of 10% compared to Q1 of 24% reduction from 1 year ago. Because electrical segment performance was so dominant, its overall quarterly EBITDA increased 122% compared to 1 year ago. Compared to Q1, that's a 76% increase, and that was outstanding. So the Q2 performance is, I would call it a blowout performance. The reason it had such an outstanding EBITDA performance was because, first of all, the 40% revenue increase. Also, importantly, its EBITDA margin increased to 39% from 24% in the electric segment, and that's driven by the very strong residential market. And as a result, the industrial supply could not meet the increasing demand, and Atkore could raise price. Even its input cost was only up very modestly. That's why its quarterly EBITDA increased so much. Atkore outlook for the fiscal year 2021 EBITDA is $700 to $750 million. That's significantly more than its guidance given in Q1 at $450 million. And Atkore also gave some outlook guidance for fiscal year 2022. The EBITDA is expected to have a normalized back to $400 to $450 million. So that's still higher than its guidance given in Q1 at $400 million. In the Q1 and the Q2 combined, its cash generated from operations is about $266 million. That's about 80% of its EBITDA. It spent about $20 million in capex and $44 million in mergers and acquisitions, including the PRE acquisition that adds a fiberglass conduit to its portfolio. So it's a very good complement to its existing PVC and metal conduit. It also used the cash to reduce debt by about $40 million and bought back stocks for about $35 million. So if we add all these cash outlay together, we get about $140 million. That's significantly less than the CFFO of $266 million. I believe the reason Atkore gave fiscal year 2022 outlook was to manage the expectation of investors, since it's going to normalize to the historical trend. So it is too optimistic to look at the evaluation of its valuation using the 2021 EBITDA. Instead, if we use 2022 EBITDA of $450 million and its current enterprise value, we get a ratio about 10 and versus the 14 for the industrial peers. So the conclusion is that Atkore is still undervalued at the current price level, despite the very significant price increase in the last 6 months. And that's not counting down the significant free cash flow that can still be used to increase future EBITDA, for example, through mergers and acquisitions. It also can be used to buy back shares, and that will increase the stock price also. As a note, that the stock price currently is $84 per share, and I believe that is still undervalued. Ingredion also reported its latest earning in this week. As a reminder, Ingredion makes core and specialty food ingredients. The most interesting part is its specialty ingredients that are shown in the 5 areas in the top right graph. That is aligned with the healthy eating trend and will drive future profit and revenue growth. So its latest quarterly sales went up by about 5%, and its adjusted operations income went up 20%, driven by better profit margin. Speaking of which, the gross margin was 22%, same as Q3 and Q4 last year, and went up slightly from 21% 1 year ago. This bottom graph shows its sales recovery progressively in the 4 quarters in 2020. So the Q1 sales up by about 5%, and that's a slowdown from the previous recovery, but it's still improving in the right direction. As I mentioned earlier, the investment thesis in Ingredion is really its stealth growth story, because its a specialty segment, the revenue has been steadily increased in the last several years, and is targeted to reach about 35% in 2023. Because it's a specialty ingredient segment has higher profit margin, so its profit will increase faster than its revenue growth. So this right-hand graph shows cash flow and outlay in 2020. So Ingredion usually generates about $700 million of cash from operations, then spends a little over $300 million on capital expenditures, and $175 million on dividend. Then the rest of the free cash flow can be used for share buybacks or mergers and acquisitions. For 2021, its capex is expected to be about $340 million, and dividend stay about the same at $178 million. It spent $40 million to buy back shares in Q1, and very active with acquisitions and partnership in the Q1 in this year, including K-Tech. I took a partial interest in Amiris. So Ingredion spent about $242 million in mergers and acquisitions last year and $52 million in 2019. So likely it will remain very active with mergers and acquisitions in 2021. In Q1, it reported an impairment charge of $360 million. That's related to setting up Atkore joint venture in Argentina. I believe that's just a tax-related maneuver, and doesn't really change my judgment of its capital efficiency. So to summarize, Ingredion's latest quarter operating income increased 20% due to better margin. Because it's a specialty ingredients business which has a better margin. Its growth story is on track. So if we look at its valuation levels, its trailing 12-month EBITDA is about $900 million if we exclude restructuring and impairment charges. At $92 per share, its market share is about $6.2 billion. And that gives a forward PE about 14 and EV over EBITDA about 8.7. So I believe that's still undervalued, and I will continue to hold the Ingredion and wait for its growth story to play out. Thanks for watching this episode of Quest for Ties. Until next time, happy investing.